Welcome you all once again on the video lecture of ICI, and today we are going to cover Ind AS 21. Ind AS 21 is a standard which talks about the foreign exchange transaction, the foreign exchange rates. The title of the standard is the effect of changes in foreign exchange rates. The effect of changes in foreign exchange rates. So this standard typically talks about foreign currency involvement, foreign currency transactions. So it is primarily dedicated to foreign currency transactions, right? Now let's discuss what is the relevance of this standard and why this standard was issued. What was the objective for taking this Ind AS into the portfolio of the entire Ind AS? So let's say I'll start with an example. Reliance Industries Limited is a big organization, right? RIL. It is one of the largest organization of Asia, Reliance Industries Limited. Now, what Reliance Industries Limited does, so the directors of Reliance Industries Limited or the top management of the Reliance Industries Limited frequently used to travel to the foreign countries, right? RIL is getting some consultancy from the foreign countries, the consultant from the foreign countries. RIL is also acquiring some raw material from the foreign countries, right? So which examples I have taken? I have taken an example where the key management personnel, top management, senior management or directors of RIL used to travel to the foreign countries, right? They are getting some consultancy from the foreign currency, from the foreign country consultants, foreign consultants, right? They are acquiring some raw material from foreign countries, okay? So what this all is about, this is known as a foreign currency transactions. This is known as foreign currency transaction. Foreign currency transactions. So if these persons are traveling to USA, if the consultant has to pay into USA, if the raw material has to be acquired from USA, the payment has to be settled in foreign currency, right? For example, you must have traveled to some foreign countries for your leisure trip, right? So what we were doing, we are getting INR converted into US dollars, right? Or into the currency of that particular country. Okay. For example, 3 years before I was traveling to Dubai. So what I did, I have converted my INR into AED, Arabian Dirham, right? Because INR will not be, circulated there. INR is not a right currency in UAE. In UAE, you have to do the transactions in AED. Couple of years back when I visited to Singapore. So in Singapore, the currency was Singapore dollar. So I need to get my INR converted into Singapore dollar, right? When I travel to, let's say, USA, so US dollar is a currency which I have to convert it from INR to USD. So the one is foreign currency transactions. Now the question arises, sir, if Reliance is paying to the foreign consultants in the tune of 1 lakh US dollar, how this 1 lakh US dollar has to be recorded in Indian books, right? Because books तो इंडिया की हैं, right? रिलायंस को जो अपनी किताबों में बुकिंग करनी है वो तो इंडियन रुपी में करनी है. So the point is how these foreign currency transactions are required or should be recorded in the functional currency or in the entity's currency, right? So that is one. So this standard is required, which gives you the clarity, which gives you the guidance, okay? The initial recognition, for example, today you are acquiring a consultancy services from a foreign consultant. So at what rate it has to be converted? Second, it also talks about, for example, if you have not paid to the foreign consultant, now the balance is still outstanding at the end of the year, right? So at the end of the year, I mean to say at balance sheet date, what should be the subsequent recognition, whether this foreign currency payment, whether this foreign currency liability needs to be restated or need not to be restated, right? So this standard talks about the recognition and measurement of foreign currency transaction as well. Okay, so that is the first thing. Had this standard not been there, it was difficult to get the uniform and consistent guidance about recording of foreign currency transaction. That is number one. Number two, like this Reliance has a foreign operations. This Reliance has a foreign operations. What is meant by foreign operations? For example, Reliance has a subsidiary, right? If you will just download the annual report of Reliance, you can see a lot of subsidiaries are there. Even foreign subsidiaries are there. Reliance has a associate, joint venture, branches, right? So Reliance Industries are having all these things. They have a subsidiary in Singapore. They have associate in Japan. They have joint venture in USA. They have branches in South Africa. They have branches in Middle East, right? They have branches in Japan. So they have foreign operations, either in the form of subsidiary, associate, joint venture, or branches. Now the question arises: Reliance is the main entity, right? And this entity is operating into India. Now Reliance, as far as branches are concerned, Reliance needs to consolidate the results of the branches into the standalone accounts. As far as subsidiary, associate, and JV is concerned, Reliance needs to consolidate the result of subsidiary, associate, JV. These financial statement needs to be converted into Reliance currency, into the Reliance as an entity's currency, right, which is INR as of now. So now the question arises: how the foreign operations financial statement needs to be translated, okay, because these foreign operation financial statement must have been presented into the different foreign currencies. So this standard gives you the guidance about translation, please concentrate on this word. In the initial part, I have talked about recording of foreign currency transaction. Now I am talking about translation of foreign operations financial statement. Translation of just a minute. I think there is some problem. Yes. So the first one was foreign currency transaction. The second one is your foreign operations, right? Foreign operations, which is subsidiary, JV, associate, branches. Okay. And this is known as translation of, I think there is some problem in my digital pen. Just a minute. I hope this screen is visible. So let me write here. Yes. First, I have talked about the recording of foreign currency transactions. Foreign currency transactions. Okay. So that is one, recording of foreign currency transactions, which we talked about. For example, why these foreign currency transactions are happening. For example, travel. For example, consultancy, raw material acquisition in foreign currency. Right. Second, that is number one. Number two, why it is required. Number two, Reliance as an entity must have some foreign operations, right? They are operating in foreign countries in the form of having subsidiary. joint venture, associate, and branches. Okay, associate and branches. Now the question arises how to translate these foreign currency financial statement into the reporting entities currencies, right? Reporting entity currency into the Reliance currency. Okay. So translation of foreign operation financial statements. Third example, Reliance. Reliance is taking a loan from Japan. Japanese investor is there, and Reliance is taking a loan of, let's say, 20,000 crores from Japanese bank. Now the Japanese bank is asking to present the financial statement of Reliance into Japanese yen, into the Japanese currency. Reliance financial statement have been prepared into INR, right? Now they are asking, no, we don't understand INR financial statement. We understand only Japanese yen financial statement. So please convert your financial statement into Japanese yen, and then only we will be able to analyze your case and we will be able to provide you a loan. So in this case, Reliance has a functional currency of INR. I'll discuss what is functional currency, but for the time being, Reliance is preparing its financial statement into INR. But now, Reliance is required to present its financial statement because Reliance is getting a loan from the foreign lender. So in this case, Reliance has to convert its INR financial statement into Japanese yen financial statement, right? So the functional currency, the main currency is INR, but Reliance has chosen, right? Reliance is not required to, Reliance has chosen, right? Because if the Reliance would not have taken a loan from Japanese bank, probably it is not required to present its financial statement into Japanese yen for them. So now Reliance is choosing to present its financial statement into Japanese yen, right? So this is known as a presentation currency. Right? So now the question arises how to translation of functional currency, or let's say translation of financial statement into presentation currency, right? For example, INR financial statement to Japanese yen currency. Okay. I have taken this example from the perspective of Reliance. Let me write here that this is Reliance from the perspective of Reliance Industries Limited, which is Indian company, right? And what we are reading here, what we are learning here, that why this standard was issued, right? I mean to say, what guidance this standard provides for. Okay. I hope this is clear to all of you. Guys. Is that clear? Yeah. Any doubt? Good morning, Namrata. Good morning, Sriram. Good morning, Viraj. Good morning, Radhika. Good morning, Rohan. Yeah. We understood that this standard has been issued to cater three kind of things. One, to record the foreign currency transactions. When I'm saying the recording, I'm talking about recognition and measurement, right? Initial recognition, initial measurement, subsequent recognition and subsequent measurement. Okay. Then this standard talks about the translation of foreign operations financial statement into the parent financial statement, into the parent currency. Okay. Then third, this standard talks about how to translate your own financial statement into a different presentation currency. Okay. Now let's discuss one by one. Okay. Objective we have totally discussed. Objective of this standard is to prescribe how to include foreign currency transactions and foreign operations in the financial statement of an entity, and how to translate financial statement into presentation currency. So these 3 points I have already covered about, right? Foreign currency transactions, foreign operations, and presentation currency. The principal issues are which exchange rate to use and how to report the effect of changes of exchange rate in the financial statement. If the exchange rate is changing, the dollar is rapidly changing, the exchange rate of dollar versus rupee is rapidly changing. So how to report this change in exchange rate? Is it into P&L, OCI, balance sheet, where? Okay. So this standard gives you the guidance about that. Coming to the scope part, this standard shall be applied in accounting for transaction and balances in foreign currency, except for those derivative transaction and balances that are within the scope of Ind AS 109. Ind AS 109, so probably from the next week, you will be able to learn the financial instrument standard, which is Ind AS 109, right? So some derivative transactions are covered under Ind AS 109. So this standard, if these are foreign currency derivatives, right? So this standard is not applicable on those foreign currency derivatives, but otherwise this standard shall be applicable in accounting for the transactions and balances in foreign currencies. This standard is also applicable in translating the financial statement of foreign operations, right? Of foreign operations while doing the consolidation. This standard is also applicable in translating an entity results and financial position. Results and financial position means financial statements into a presentation currency. Okay. So this is foreign currency transaction. This is foreign operations. This is entities on financial statement into a presentation currency. These 3 items I have already spoke about in detail. Now, what is not covered in Ind AS 21? So friends, in our accounting standard, we have AS 11. Are you able to remember that AS 11, the effect of changes in foreign exchange rates? Are you able to remember or recall that particular standard, AS 11? In AS 11, there was 2 treatment of long-term foreign currency loans, right? And what was the 2 treatment? One, it says that if there is a change in exchange rates, that has to be taken to the P&L. The exchange rate impact has to be taken to the P&L, right? If you don't want to take it to the P&L, there was an alternative treatment as well. I am talking about AS 11, accounting standard 11, old accounting standard. If you don't want to take it to the P&L and there is a exchange fluctuation, there is a exchange loss, exchange difference, what you can do? You can amortize that exchange difference into the remaining period of the loan, into the remaining tenure of the loan, so that the entire hit will not come into the same period in the P&L. Or if that loan has been taken for the fixed assets, in that case, whatever exchange losses are there, whatever exchange gain is there, whatever exchange difference is there, that has to be capitalized or that has to be adjusted to the fixed assets. So this was the alternative treatment given into the AS 11, and the paragraph was paragraph 46 and paragraph 46A. But in Ind AS does not give you these kind of treatment. It does not tell you that if there is an exchange difference, amortize it over a period of loan. No. If there is an exchange difference on the foreign currency loan taken for fixed assets, you cannot adjust your fixed assets. Okay. So Ind AS 21 says that whatever exchange difference is there, it has to go to the P&L. That's all. On foreign currency transactions. I am talking about foreign currency transactions. For example, if you have taken a loan in the foreign currency, it is a foreign currency transaction, right? So this is the major difference between Ind AS 21 and AS 11. But when we implemented Ind AS in from the year 2016-17, a lot of Indian companies were having foreign exposures, right? So these industries, these big companies have written to ICAI that we have a huge amount of foreign currency loan outstanding in our balance sheet, right? In our old accounting standard, we were capitalizing this into a my fixed asset or amortizing it. But now, while implementing Ind AS, it says that everything should go to P&L. So we will have a big impact on our P&L, right? And we were not aware of, because suddenly this Ind AS came and the treatment has been changed. So in this case, there is a standard Ind AS 101. Ind AS 101 talks about first time adoption. When you read Ind AS 101, you will find that Ind AS 101 has given an exemption. It says that the Indian companies which are implementing Ind AS, right? So the Indian companies which are moving from accounting standard to Ind AS, if they have taken a foreign currency loan prior to the date of implementation of Ind AS to that company, so whatever treatment they were following in accounting standard 11, they can continue to follow the treatment for the older loans. But if they are taking a new loan, then of course Ind AS 21 treatment will be applicable. So this is an exemption given for the Indian companies in Ind AS 101 for the first time adoption of Ind AS, right? So that is why this exemption is there. This exemption is given in not in Ind AS 21. So this exemption is given in Ind AS 101, but of course there is an impact on Ind AS 21 as well, because Ind AS 21 says that take it to the P&L, right? But it says that for the old loans, you can continue the same treatment which you were doing in your AS 11. You will read this concept in detail in Ind AS 101. Okay. So this is a carve out which we have taken in Ind AS 101. Hedge accounting for foreign currency item. Like I have told you, if there are some foreign currency derivatives which are covered in Ind AS 109, that on those derivatives Ind AS 21 is not applicable. Ind AS 109 is applicable, right? So this is a carve out. This is not applicable. Presentation of cash flow from transaction in a foreign currency. If you are translating your cash flow statement, presentation of cash flows from transaction in a foreign currency. So if you have done any transaction in foreign currency, so how to present those transactions into the cash flow statement? So that kind of guidance is given under Ind AS 7, not under Ind AS 21. Okay. Is that clear? Namrata is asking, sir, what is the difference between branch and subsidiary? So Namrata, subsidiary is more like a legal entity where the company has acquired shares, where the company will have a control. But branch is just like an extension, right? You must have seen that DPS. Have you seen Delhi Public School? So Delhi Public School is having, let's say, around 50 branches all across India, but institution is one only, right? So the parent entity will always be one. For example, there is a DPS Trust Society or DPS Private Limited. This is an entity, and this entity is having so many branches all across India, right? But what is meant by subsidiary? Subsidiary is where the company has acquired control, where the company has invested in the equity of that entity. So subsidiary is a legal entity, but branch may not be a legal entity, right? Now, we are going to discuss the heart of the standard. What is meant by heart of the standard? We are going to discuss the three important currencies, right? What are those three important currencies? First of all, in AS 11, we were talking about, in AS 11, we were talking about three currencies. What were those three currencies? Local currency, foreign currency, presentation currency. Sir, what is a foreign currency? The easiest definition. What is a foreign currency? The foreign currency is a currency which is not a local currency, or the foreign currency is a currency other than a local currency. For an Indian company, what is a local currency? For Indian company, local currency is INR. What is foreign currency? All currencies other than INR are foreign currencies. What is presentation currency? The currency in which the entity is presenting the financial statement is known as a presentation currency. For Indian company, local currency is INR, presentation currency is INR. All currency other than INR is foreign currency. Or if Indian company, for example, Reliance is listed in London Stock Exchange, is listed in Japanese Stock Exchange, for example, and for London Stock Exchange, they are filing into US dollar or into Great Britain pound or euro, or for Japan, they are filing into Japanese yen. So this Japanese yen and this US dollar or Great Britain pound or euro, of course, this is a foreign currency, but it becomes a presentation currency when they are presenting their financial statement into that currency, right? So the major currencies of two type, one is local currency, one is foreign currency, right? Presentation currency is a currency in which the financial statement are presented. Okay, so presentation currency could be a local currency, could be a foreign currency, right? So these three concepts we have read in AS 11. If I talk about these three concepts, right? Foreign currency concept is same, presentation currency concept is same, but the word local currency has been replaced with the functional currency, right? The word local currency has been replaced with the functional currency, okay, in Ind AS. And it is a big change, I would say. Let's understand what these three currencies talks about. Closing rate, you all are aware, closing rate is the spot rate at the end of the reporting period. Exchange difference is the difference resulting from translating one currency into the another currency at different exchange rates, right? Foreign currency is a currency other than the functional currency. So जो भी functional currency नहीं है वो foreign currency है. That's all, right? जो भी foreign currency नहीं है, that is a functional currency. Okay. Sriram is saying, sir, you said that branch may not be a legal entity. Sriram, branch may not be a legal entity does not mean it's an illegal entity. Legal entity means separate legal identity, right? Let's say the head office, you tell me, head office, let's say Reliance Industries is having a head office in Jamnagar, in Gujarat, for example, or in Ahmedabad. Adani is having its head office in Ahmedabad. They are having branches all across India. So you tell me, if income tax return has to be filed, if income tax return has to be filed, so whether this income tax return has to be filed for head office separately, for all the branches separately, or for a company as a whole, which is Adani Enterprises Limited, tell me whether the PAN number has been issued, whether the PAN number has been issued for every branches and head office, or it has been issued for Adani Enterprises Limited as an entity. Of course, it is Adani Enterprises Limited as an entity only. The branch and head office is not required to file that income tax return separately. If I talk about financial statement, whether the financial statement needs to be filed and needs to be published for all the branches and head office, or all the branches and head office put together as one entity, which is Adani Enterprises Limited. Of course, it has to be one entity only. So when I'm talking about a legal entity, I'm talking about from the identity perspective, right? And I have taken an example of DPS school, right? I have taken an example of DPS school. I have taken an example, let's say Mount Carmel School, right? St. Xavier School. So you can see that St. Xavier School is all across India, but it is run by a particular company or a society, right? Every St. Xavier School is not having a separate PAN card probably, or it may have, right? but it functions like a branch. It functions like a branch, right? GD Goenka. So GD Goenka is one company and they are running schools within that entity, right? And those schools are like branches. They are maintaining their separate accounts. They're filing their GST, everything, right? But they are not separate legal entity. Is that clear, Sriram? They are not having their separate share capital, but a subsidiary company will have a share capital, right? Yes, foreign currency is a currency other than the functional currency of the entity. Okay. Foreign operation is an entity. We have discussed that, which is subsidiary, associate, joint arrangement, or branch of a reporting entity. The activity of which are based or conducted in a country or currency other than those of the reporting entity. Foreign operation means an operation outside the reporting entity's operations, right? Functional currency is the currency of the primary economic environment in which the entity operates. In which the entity operates. What is meant a group? Group is parent and all its subsidiaries. Monetary item, non-monetary item we will be discussing later on. Presentation currency is a currency in which the financial statement are presented, right? Now let's talk about functional currency. So friends, we have spoken about three currencies. Functional currency, we'll discuss in detail. Foreign currency, presentation currency. These three terminology has been used in this standard. Foreign currency is very simple. What is foreign currency? Foreign currency is a currency which is not a functional currency. But for functional currency, you cannot say that functional currency is a currency which is not a foreign currency, right? You cannot say that. So foreign currency क्या है? Foreign currency वो currency है जो functional currency नहीं है. Okay. And functional currency is just a replacement of a local currency. If I compare between Ind AS and AS, so functional currency is a replacement of local currency. Presentation currency कौन सी currency है? Presentation currency is a currency in which the financial statement are presented. That's all. So the most important definition is functional currency, which we need to understand. Okay. Now the definition is functional currency is a currency of the primary economic environment in which the entity operates. You know, what is the difference between a local currency and a functional currency? Local currency is a currency of geographical environment. For example, an entity, ABC Limited, has been incorporated in New Delhi in India. So ABC was incorporated in New Delhi in India under Companies Act 2013, right? So what is the local currency of ABC? What is the local currency of ABC? The local currency is INR. Why? Because local currency is a currency of geographical environment where the entity has taken birth. Okay. But this Indian entity, which is having a headquarter in New Delhi, this Indian entity has all the primary operations in USA. They are providing the services in USA. They are providing services in USA. They are incurring cost in USA. They have hired some consultant in USA. They are delivering the services. They are probably, this company is an IT company and they are having a KPO and they are providing the entire services. Their revenue is generating in US dollar. They are paying in US dollar because the consultants are in USA, right? So the 90% of the operations of this Indian entity is into US dollar. Now friends, just respond with a question. This Indian entity who has a 90% operations in USA, they will be bothered about Indian environmental changes. They will be bothered about Indian political changes, or they will be more bothered about USA political changes. होता है ना, इंडिया में इलेक्शन होने वाले हैं, अगर सरकार चेंज हो गई, गवर्नमेंट चेंज हो गई, क्या पॉलिसी लेके आएगी, हमारे बिजनेस पे क्या इम्पैक्ट आएगा, सो ये सब हम सोचते हैं ना. So whether this entity who has a 90% operations in USA, 90% overseas operations, whether they will be bothered about Indian political system changes or they will be bothered about US political system changes? Tell me. Tell me. Rahul is saying, sir, they will be more bothered about USA. Hanvi is also saying, sir, they will be more bothered about USA, right? Political changes in USA. So why? Because their primary operations in USA, their major bread and butter will be in USA. So going by the definition of a functional currency is a currency of primary economic environment. So what is the primary economic environment for this entity? Is it India or is it USA? Of course, it is USA. So if it is USA, what should be the functional currency? What should be the currency of primary economic environment? What should be the currency of primary economic environment? US dollar, right? So US dollar is the functional currency in this case. Sir, an Indian company, functional currency, main currency become US dollar? Answer is yes, as per Ind AS and as per IFRS. Sir, if it is US dollar, whether they have to prepare their financial statement in US dollar? Answer is yes, they have to prepare the financial statement in functional currency. But sir, don't you think this company has been incorporated into India? They have operations in USA, but this company is incorporated into India. They have to file income tax return. They have to file their financial statement to MCA, ROC, right? They have to file their financial statement into ROC. They have to file their financial statement to, let's say, they have to file the income tax return. And if their case comes into scrutiny, they have submit this financial statement to income tax department also. Sir, how do these regulators will understand the US dollar financial statement? My dear friends, in this case, they have to present their financial statement into which currency? Into INR. Into INR. So in this case of ABC Limited, the functional currency is US dollar. The presentation currency will become INR. The presentation currency will become INR. And you remember, I have told you three cases. What we are going to learn in this standard. You remember, I have told you three cases. Translation of financial statement into a presentation currency. Yeah. So this rule will be applicable. So in this case, an Indian company who is having a functional currency of US dollar, they have to present their financial statement into INR. So they have to apply the translation of financial statement rule into presentation currency, right? Which we are going to learn in the third part. Is that clear? Is that clear? Namrata has quoted a very good word here. She has told that, sir, it's substance over form. Substance over form. Very good. Right? But you don't have or you have not read this kind of concept in accounting standard. In accounting standard, the concept was pretty simple. In accounting standard, the concept was local currency, right? So local currency means this ABC Limited, if incorporated into India, doesn't matter where it is operating, how much business it is getting from which country, the always local currency will be INR only. But in Ind AS, because Ind AS is a Indianized version of IFRS, this is converged IFRS. IFRS is a global concept, right? So it is more on the basis of substance over form, right? And it says that the primary economy, because the financial statement will be influenced about the environment in which the entity is primarily operating, right? This entity is hardly bothered about Indian system, right? Doesn't matter whether what the price will be there in India, doesn't matter, right? They will be bothered about the US environment, right? Because their primary operations into USA. So if their primary business into USA, then why not functional currency should be US dollar? I think it's very logical, right? Right? And they have also given you a choice, sir, but how do we present in India? So they have given you a choice. You can choose your presentation currency, right? So that is why in this case, the presentation currency should be INR, functional currency should be US dollar. And for this entity, other than US dollar, all other currency will be foreign currency, right? Is that clear? Is that clear? Viraj is saying, sir, it is difficult to understand currency other than INR, US dollar, and euro. Can you tell me the different currencies other than above mentioned with symbols? Viraj, don't worry, right? In exam, if different currency, for example, Saudi Riyal, right, Arabian Dirham, okay, let's say Japanese Yen, Chinese Yuan, if these currency will be there, then the name also will be there. Okay, don't worry about that, right? So in examination, in solving the problem, you will not have any problem. Don't worry about that. There are 200 countries. Probably there are 100, more than 100 currencies. Namrata is asking how we understand various primary operations of the entity. So Namrata, it is very simple to understand that from the segment reporting, that where the physical operations are, from looking at the sales or revenue, from looking at the expenses, right? So in standard, some indicators have been given. Let me talk about those indicators. Now, what is meant by primary economic environment? So standard says that primary economic environment is normally the environment in which the entity primarily generates and expends cash. The entity is primarily generating cash and expending cash. Means the primary operations, means the primary revenue is generating from a particular environment, from a particular geography, right? Or the entity is expanding into a particular geography. Now, the standard has given you some indicators. What are those indicators? Let me talk about. Sir, for example, a company is having operation in India, USA, and China. They are having operation in 3 countries. So how can we identify what is the functional currency? Because functional currency should be one. So how can we identify that? So standard has given you 2 indicator, which is primary indicator and secondary indicator. So what is the primary indicator? The primary indicator is the currency. It says that the currency which mainly influences sales prices or labor, material, and other cost of providing goods or services. Right? Labor, material, and other cost of providing goods or services. For example, iPhone. If US will increase the price of iPhone, probably the price of iPhone will be increased all across the world, right? Or let's say if US dollar will become stronger, right? Your IT services cost may go up, right? For example, when US will go down, your IT stocks will also go down. When US market will be flourishing, your IT stocks means IT share prices, IT company share prices will also flourish. So you must have seen that these IT companies are directly related with US market. Okay. So what is the primary indicator? It says that you have to see the currency which mainly influences the sales prices, the currency which mainly influences the input cost, labor, material, and other cost of providing goods or services. That will become the primary currency. That is the primary indicator for identifying the functional currency. So you need to see in which currency the major sales is happening, in which currency the input cost is also happening, right? For example, in this case, the 90% of the operations, the 90% revenue was in US dollar. The 90% of the expenses were also in US dollar, right? So you need to look at the primary indicator, which currency, in which currency the major sales are happening, in which currency the major input cost is happening, right? That is number 1. Number 2, if you are not getting an answer from the primary indicator, for example, you have seen that my 50% of the revenue is coming from USA and 50% of the revenue is coming from my China. And likewise, my 50% cost is from China and 50% cost is incurring into USA. Or let's say it is 40-40, for example. So going by the primary indicator, you have a, lagbhag about to You have an equal proportion of the sales and input cost. Now it is difficult to finalize which should be my functional currency. So standard says that then you have to look at the secondary indicators. What are the secondary indicators? The secondary indicators are the third condition. You need to look at in which currency the entity is generating the funds from financing activities. Funds from financing activity means in which currency the entity has raised capital, in which entity the entity has got finance in terms of debt. For example, the company has raised a debt in the form of external commercial borrowing, and this debt has been raised from the US market, right? So this debt is into US dollars. So it means combining the primary and secondary indicator, US dollar may be my functional currency. Or you have to look at what is the currency in which the receipts from operating activities are usually retained. So whatever amount it is coming, you have to look at in which currency bank balance, in which currency bank account it is going to be maintained. So the companies are having EEFC account, exchange earning foreign currency account, right? For example, whatever residual is coming, the entity is maintaining in US dollar account, which means the receipts from operating activities are retained in US dollar, right? So friends, for finalizing the functional currency, you need to look at two indicators, primary indicators and secondary indicator. In primary indicator, you need to look at primary and secondary. In primary, you need to look at the revenue, sales, and cost. In secondary, you need to look at your financing activity, I mean to say equity and debt, and you need to look at the retained profits or retained cash earnings, right? In which currency the sales are happening, in which currency majorly the cost is incurring, in which currency the financing activity have been generated, the equity has been raised, the debt has been raised, or in which currency the remaining balance, the retained amount has been retained or maintained, in which is it in INR bank account, is it in US dollar bank account, is it in Chinese yuan bank account? So you need to look at that thing, right? So we will understand this with the help of more examples. But I hope it is clear to all of you so far. I hope it is clear to all of you so far. Yeah. Is it clear? Is that clear? What we are understanding now, we are only understanding what is meant by functional currency. Functional currency is a currency of primary economic environment in which the entity operates. What is a primary economic environment? It is generally the environment in which the entity generally or primarily generate and expend cash. How to identify what is my functional currency, what is my primary economic environment, what is my functional currency? You need to see the currency in which the major sales are happening, the currency in which the major input cost is incurring, because this is the currency which will influence your sales and sales prices and direct costs, right? And the secondary indicator is you need to look at in which currency the entity is generating the equity and debt, and the currency in which the entity is maintaining or retaining the remaining receipts, right? Okay. Now let's understood this example of a functional currency. There are multiple currencies here. Okay. So let's discuss this. Companies often operate in a mixture of currencies. For example, a mobile manufacturer in China exports 80% of its production to Europe. Sales are denominated in euros, and the company also maintains books of accounts in euro. So 80% of the export for this Chinese company is into Europe, right? Sales are into euro, and company also maintain bank account in euro, right? Because their major customer are into Europe, they are sending the money in euro, right? So they have maintaining the bank account in euro. So if you will look at here, one of the primary indicator sales is in euro, right? And one of the secondary indicator, which is retained earnings, it is into euro, right? So one primary indicator, one secondary indicator. However, all other factors like currency for production cost and financing arrangement are denominated in Chinese yuan. If you will see here, so direct cost is in Chinese yuan, right? And your financing arrangement, your financing activity, this is also in Chinese yuan. So one primary indicator, one secondary indicator is in Chinese yuan. So now you tell me what should be the functional currency. So in this scenario, such scenario is judgmental, but would likely indicate yuan to be the functional currency. So in this case, management has to apply a judgment that which currency the management has to give more weightage. Which currency the management has to give more weightage. For example, in this case, management may take a decision that my functional currency will be Chinese yuan. Why? Because the production cost is more important than the, I would say, than the sales, right? First cost comes, then sales happens. Okay. So probably if the cost will increase, the sales may, thus accordingly the sales prices has to be fixed. So this entity has decided to finalize Chinese yuan as a functional currency. But sir, is there any guidance? Answer is no. In that case, the management has to apply the judgment, the best estimate. What should be my functional currency? In these kind of scenarios where multiple currencies are there and you are indifferent because the weightage is similar. Like you have seen that one primary indicator, one secondary indicator is into euro and the another primary indicator, another secondary indicator is in Chinese yuan. Sir, what happened if the entire production cost is in Chinese yuan, but sales is into euro, retained earnings are maintained in euro, and financing activities are also into euro? In that case, my all secondary indicators are euro. My one of the primary indicator is euro. So in that case, the functional currency will be euro, not it will not be Chinese yuan. Okay. Is that clear? Second example, I have a lot of example to make you guys understand the meaning of functional currency, right? We are only discussing what is functional currency from the entity point of view. Case study again, entity a listed company on the New York Stock Exchange, is engaged in the development and manufacturing of pharmaceuticals. So entity A is a listed company and this listed company is listed into USA. The entity's main manufacturing facilities are located into the US, right? So the main production is in USA. The main plant is in USA. Entity A has outsourced 30% of its manufacturing to a German entity, to an entity in Germany, and entity A pays the German entity in euros. So this entity A is a US based entity listed in USA. And this entity's main production plant is into also USA, means the production cost is incurring into USA, US dollars. But 30% of the production cost is outsourced to the German entity, means 30% is into euro, 30% of the production cost, 30% of the direct cost is into euro, and 70% of the cost is into US dollar, right? Can we assume this by reading these three paragraphs? The cost of the US factory are almost double the cost of the German factory. But it says that the cost of the US factory is double. And I can say that 70% ho gaya na? 70% US, 30% Germany. So 70% US dollar, 30% euro in terms of cost. Entity A on a consolidated basis, the group. So basically entity A, right, on a consolidated basis, it is saying that it is financed 70% by debt, which constitute short and long-term bonds traded on New York Stock Exchange and denominated in US dollar. So secondary indicator, you remember secondary indicator, the currency in which the financing activities has been done. So it is saying that first primary indicator we have understood. If I talk about my primary indicator, my cost, my 70% cost is in US dollar, my 30% cost is into euro. If I talk about my financing activity, this is a listed entity, and if it is a listed entity, probably it has raised its capital into US only, right? And the debt, 70% debt is in US dollar, right? Now let's talk about revenue. What is revenue? So they have given the revenue number also. 70% of the revenue is in US dollar, 20% in euro, and 10% in multiple currencies. 70% USD, 20% euro, 10% miscellaneous. So 70% of the primary indicator, which is revenue, is into US dollar. 70% of the another primary indicator, which is cost, is again US dollar. And 70% of the secondary indicator is again US dollar. According to you, what should be the functional currency of this entity? According to you, what should be the what should be the functional currency of this entity? Yes, Rohan, you're right. It is US dollar only. Why? Because the primary indicator indicates that the majority of the sales, majority of the cost, and majority of the financing activities has been generated in US dollar, right? So what is the functional currency of entity A? The functional currency of entity is US dollar. Entity A's functional currency is probably USD. The primary indicator clearly identified a functional currency. What is my primary indicator? The currency that mainly influences the sales prices, labor, material, and other cost of providing goods or services. 70% of entity A's revenue are arising in US and denominated in US dollar. Entity A's main manufacturing facilities are located in US and Germany. The cost of US factory is almost double the cost of German factory. Right? Is that clear? Is that clear? Very good, Janvi. Very good, Namrata. Great, Rohan, Radhika. Yes, you're absolutely right, Surbi. Another case study. Spider-Man Limited, a company in USA, holds a subsidiary in India, Batman Limited. So Spider-Man Limited is a US based company. Batman Limited is a Indian company, right? Spider-Man bahar ka, Batman India ka. Batman, which is B Limited, assembles all goods in India using combination of locally sourced material and material manufactured by S Limited. So B Limited assembled all goods in India, right? So B Limited is assembling in India using combination of locally sourced material. So B Limited is assembling goods using Indian raw material and using raw material supplied by the Spider-Man, which is US based company. So the input cost is in India, INR, as well as US dollar, right? All goods are exported and sold to Japan. However, entire goods are exported and sold to Japan based on selling price determined by S, which is USA, and influenced by Indian market. So whatever Batman is selling, so the entire sale is into Japan, means Japanese yen. But who is finalizing the price? Who is finalizing the price? Spider-Man Limited is finalizing the price. But this price is influenced by Indian market. So which currency is influencing the price? Which currency is influencing the price? INR, Indian market is influencing the price, right? It is Indian government, it is Indian regulator who is fixing the price, that at what price the export has to happen. This Batman Limited also have a working capital loan from State Bank of India. So here it talks about cost. Here it talks about revenue. Here it talks about the financing activity, which is your secondary indicator. These two are primary indicator. This is secondary indicator, which is given in the question. And you are required to determine the functional currency of Batman Limited. Now, I'm giving you 30 seconds. I'll take a pause here. I'm giving you 30 seconds and you need to tell me what should be the functional currency. Janvi has answered. Janvi is saying functional currency is Indian currency. Okay. What about others? Rohan has also told that functional currency is Indian currency. So the cost is 50-50. Almost we can say that the cost is combination of US dollar and INR. But revenue, entire revenue is to Japanese yen, but it is influenced by Indian market. There is no role of USA. They're only determining the price, right? And the secondary indicator, the financing activity, the working capital loan has also been taken from State Bank of India, means INR. Yes, you can see. Let's do the analysis. Sales, the revenue is into Japanese yen, right? But the revenue is influenced by INR. The currency which is influencing the sales is INR. Expenses is into INR. The purchases, the raw material is into INR and USD. The financing activities has been maintained in INR. The cash flow may be maintained in INR, US dollar or Japanese yen, maybe, right? So we are not aware. You can see the most common answer which is given by all the factors is INR. So INR is the functional currency. Please let me know if you have any concern, any issue in this case. Right? Sri Ram has said functional currency of B Limited is INR since it is the currency of primary economic environment. Even though it is a subsidiary of foreign company, it is mainly originated from India and entirely governed by Indian market rules. Great, Sri Ram. Very well explained. Now, let's see one more illustration from ICI study material. Future Limited sells a revitalizing energy drink that is sold throughout the world. So, Future Limited is a company which is into energy drinks, right? And this energy drink is sold throughout the world. The sales of the energy drink comprise over 90% of the revenue of Future Limited. And this energy drink sales, this energy drink revenue is 90% of the revenue of Future Limited. Means the entire, if I compare this revenue from the energy drink, it constitutes 90% of the entire revenue. For convenience and consistency in pricing, sales of the energy drink are denominated in US dollar. Since this energy drink is sold throughout the world, so the sales price of this energy drink is denominated in US dollar. Okay. All financing activity of Future Limited are in its local currency. All financing activity of Future Limited are in its local currency. Although the company holds some USD cash reserves, right? So all financing activity of Future Limited are in local currency. So whatever local currency, let's say INR. So financing activity is happening in INR, but the company hold USD cash reserves, right? So whatever money comes, so it has been retained in US dollar. Almost all the costs incurred by Future Limited are denominated in local currency. L dollar means local currency, right? For example, Viraz, in exam, you will not be able to understand what is meant by L dollar. So you can see that it is written here, local currency. So you don't need to write the name of any currency. If it is written in local currency and your answer will be this L dollar only, you need to write the functional currency is L dollar, local currency, right? What is the functional currency of Future Limited? Guys, tell me, if you look at, first of all, revenue. Let's talk about revenue. Let's talk about revenue. If you look at revenue, 90% of the revenue is from this energy drink, right? And this 90% of the revenue is denominated in US dollar, right? Financing activity, one of the secondary indicator. This financing activity is into local currency, LC, L dollar या LC. This retained balance, the retained cash is maintained in US dollar. Almost all the costs incurred by Future Limited are denominated in local currency. Cost, almost all the cost, let's say 100% of the cost is into local currency. Now you tell me, what should be the functional currency of Future Limited? Is it US dollar? Is it local currency? L dollar? What should be that? So two primary indicator, two secondary indicator. Tell me. Sorry, tell me. I'm just having a 15 seconds pause here. What should be the right answer? Janvi is saying US dollar. Why Janvi? Why US dollar? 100% of the cost. If you look at cost, 100% of the cost is in local currency. 100% of the cost is in local currency. And all the cost, so sorry, 100% of cost is in local currency, and the entire financing activity is also into local currency. 90% of the revenue is not from the US market. It is not from the US market. For the sake of consistency and convenience, because US dollar is the most prominent currency in the world, and this energy drink is selling across the world, right? So in the US dollar, only the price has been maintained. If you look at the analysis, the functional currency of Future Limited is L dollar, looking at the primary indicators. Okay. The facts presented indicate that the currency that mainly influences the cost of producing the energy drink is the L dollar. As stated in the fact pattern, the pricing of the product is US dollar is done for convenience and consistency purposes only. The entire sale is not in US market. There is no indication that the sale price is influenced by the US dollar, right? Janvi, is it clear now? Let me know if you have any query. Let me know if you have any doubt, any problem in understanding any query. Please do let me know. Please do let me know. Ram is saying majority of factors determine local currency, hence functional currency of Future Limited is L dollar. Namrata is saying it's confusing. So Namrata, there is no confusion, I'll tell you. First of all, you have to do the analysis, right? So Janvi, sales price is in USD only. The sale price is in fixed in USD. The US market is not influencing that sale. Nowhere it is written that the US market is influencing the sale of the entire world, just for the sake of convenience. So Janvi, today I want you to talk to a exchange dealer, right? The foreign currency dealer, and just speak to them and tell them that I want to go to Bali or I want to go to Malaysia. So which currency I should carry? So everyone will tell you, please carry US dollar. Why? Because it is the most prominent currency and you will get a good price. You will get a good price there. Okay. So for the sake of convenience, like English, wherever you go, if you know English, your work will become very easy. right? And you can see that having a virtual session, the faculty are supposed to speak in English. Why? Because the students are from all across India. But had it been a physical session in North India, in Delhi, probably I was delivering this session in Hindi. Or if there is a faculty from South India, probably that faculty was delivering in Kannada, Tamil, or in English. Okay. But English is a uniform language which is acceptable to the entire world, I would say. So that is why, for the sake of convenience, this lecture has been recorded in English. Likewise, for the sake of convenience, the price has been fixed in US dollar. It does not mean that the US market, USD currency, is influencing the price, influencing the sales price, right? Is that clear? Namrata is asking, sir, we need to understand which market influence the sales price, right? You are right, Namrata. Sir, what happens if it is not given in the question? If it is not given in the question, then just you need to understand that what is given in the question. Whether it is given in the question that the entire sale is in US market. If the entire sale is in US market, in that case you have to take it to the, you have to consider that my US dollar is the primary, is the currency going by the first primary indicator. Okay. But if in the question it is written that, okay, the sales is into the US, but it is influenced by the Indian market, in that case, your answer would be different. And remember that Spider-Man and Batman example. The entire sale was in Japanese yen, but it is influenced by the Indian market. Is that clear? Is that clear, guys? Yeah. Okay. So we have talked about these 4 conditions. Okay. What are those 4 conditions? So first of all, we have spoke about, and let me quickly summarize here. Then I'll jump on to the next part. Okay. In Ind AS 20, and I believe my Excel file is visible. In Ind AS 21, guys, in Ind AS 21, we have talked about how much concept? We have talked about 3 currencies, right? We have talked about why the standard, what is the objective, what is the scope, and we have talked about the 3 currencies. Foreign currency, we have talked about the functional currency, and we have talked about the presentation currency, right? Presentation currency. Foreign currency is a currency other than functional currency, right? Very simple definition. Presentation currency is a currency in which the financial statement are presented, right? Currency is a currency of primary economic environment. Currency of primary economic environment, right? Foreign currency, all currencies other than functional currency. Functional currency, how to determine the functional currency depends on and circumstances, right? Presentation currency is a currency of choice, right? Currency of choice means you choose and to present, right? Is that clear? Now, coming to the depends on facts and circumstances, how to determine this functional currency, how to determine functional currency. The functional currency has to be determined by 2 indicators, right? Primary indicator and secondary indicator. Primary indicators and secondary indicators. What is primary indicator? What is primary indicator? Basically, you need to see currency in which sales prices are influenced, right? Second, you said influence. Sir, if it is given, then it is okay. If it is not given, then you need to say currency in which sales prices are denominated. Denominated. Okay, sir. The question is silent about influence. Then you need to see in which currency sales price are denominated, right? But sir, in the future retail example which you have taken about the influence, it was silent, right? And it was written that the for the sake of convenience and consistency, the price has been fixed in US dollar. So in the question itself, it has been clarified that it is not influencing by the US dollar, right? It is not influenced by the US market. Why? Because in the question, it is written that for the sake of convenience and consistency, right? So it says that सिर्फ हमने convenience और consistency के लिए रखा है. हमारा कोई यूएस डॉलर के प्राइस यूएस डॉलर का प्राइस गिरने बढ़ने से मेरी कोई सेल्स पे इंपैक्ट नहीं आएगा, राइट? Currency in which sales price are denominated. Currency in which input costs are denominated. Currency. Right? You have to see these three conditions in the case of primary indicator. In the case of secondary indicator, you need to look at secondary indicator. Currency in which financing activity are raised. Currency in which financing activity are raised. Right? Currency in which operating activities are retained. The cash from operating activities, right? Is that clear? Is that clear? So this is what we have talked about, the functional currency of an entity, how to determine the functional currency of an entity, right? Is that clear? In the primary indicator, we have talked about the sales and the cost. In the secondary indicator, we have talked about the financing activity, which is equity, debt, and maintaining the residual cash, or maintaining the cash, not residual. Is that clear, guys? Shall I move on? Yeah, Shriram, I have summarized this. Is that beneficial for all? I have explained, I have summarized. I hope it is good for everyone. Yeah. Okay. Yes. Now, friends, let's discuss about identification of a functional currency of a foreign operation. Identification of a functional currency of a foreign operation, right? Of a foreign operation. Yes, I'll share this Excel file. Right? And what is the how to identify the functional currency of a foreign operation? So foreign operation, additional indicator for determination of a functional currency. For example, let's say This is Reliance. RIL is an Indian company. Okay. They have just opened a branch in, let's say, Singapore, right? Now the question arises, what is the functional currency for this branch? RIL is an Indian company, and this Indian company has opened a branch in Singapore, branch office in Singapore, and that branch has been opened for facilitating the sales, recovery the money, recovering the collection, right? So this branch is for the expansion of business in Singapore. Or let's say this RIL has created a subsidiary. Instead of branch, it has also formed a subsidiary. This subsidiary in Malaysia. So let's take both the example. So branch in Singapore and subsidiary in Malaysia. They have created an entity and RIL has 100% invested in this subsidiary. So this subsidiary is a wholly owned subsidiary incorporated in Malaysia, right? So now the question arises, what should be the functional currency of this foreign operation for this branch, for this subsidiary? What should be the functional currency of this foreign operation? Standard says that, first of all, of course, for identifying a functional currency, you need to look at the primary indicator, secondary indicator. But for these foreign operations, you need to look at some additional factors as well. What are the additional factors? Number one, degree of operational independence from parent, right? Whether this branch, whether this foreign operation, this foreign operation is considered as an extension of the reporting entity or it is an independent entity. Are you getting me? Whether the foreign operation is considered as an extension to the reporting entity or it is an independent entity, means the foreign operation does not have its own individuality. I mean to say, this foreign operation is completely dependent on the parent or dependent on this RIL, right? So you need to just look at whether it is only considered as an extension, as an hissa of this main entity, or this foreign operation is having its own ways of working, its own manufacturing, its own customer, its own independent board. So what is that, right? Second, the proportion of the transaction with parent, degree of operational independence. Second, the proportion of the transaction with parent, whether this foreign operation is only having a majority of the operations from parent or it is having the operations from different entities, right? So you need to look at what is the proportion of the transaction with the reporting entity. Is it high? Is it low? You need to look at, right? Third, you need to look at the financial autonomy compared with the parent, right? You need to look at whether the foreign operation is dependent on the reporting entity for managing its obligation or the foreign operation is managing its obligation at its own. For example, if the foreign operation has to invest or has to spend some money, so whether for spending that money, that foreign operation is totally dependent on this parent, Indian parent, or this foreign operation can manage its expenses at its own, right? You need to look at that thing also. Fourth, influence of cash flows on parents' cash flows. Whether the cash flow of the foreign operation is impacting the cash flow of the reporting entity. For example, if this branch would not be able to collect cash, for example, the Reliance has opened a branch, right, in Singapore, and Reliance is supplying the entire goods to this branch. Reliance is supplying the goods from India to the branch, Singapore, right? So it means this foreign operation is considered as an extension to the reporting entity. Why I have created a branch? Just I want to expand my business, right? What is the proportion of transaction with the reporting entity? The majority of the operation is with the reporting entity. This branch is taking goods from the from the RIL India, and this branch is selling goods and remitting the entire cash to the RIL India. And RIL India is giving them some cash to managing the show, right? To managing this entire branch. So foreign operation is dependent on the reporting entity for managing its obligation. The cash flow from foreign operation, if this branch would not be able to recover or collect cash, it will directly impacting on the Reliance Industries, right? So in case of foreign operation, you need to look at four things, additional factors. Foreign operation is considered as an extension to the reporting entity, the proportion of the transactions with the reporting entity, the cash flow of the foreign operation impacting the cash flow of the reporting entity, whether foreign operation is dependent on the reporting entity for managing its obligations or not. Right. Sir, for example, Namrata is an auditor of a company, RIL. They have a branch in Singapore. And this branch is maintaining its books of accounts. Right. So Namrata, so CFO is asking with Namrata, Madam, how does it matter? We have identified that the functional currency of RIL is INR, Indian rupee. We have identified and you have also agreed. How does it matter if my branch is having a functional currency of Singapore dollar or INR? How does it matter? Then Namrata is responding, sir, it matters. If the branch will have a different functional currency, in that case, when you consolidate, when you merge the result of your foreign operations, then translation rule will be applicable. And translation rule for translating the results or financial statement from one currency to different currency is different, right? Vis-a-vis or in comparison to the rule for recording the foreign currency transaction. So Namrata is making the CFO understand. She is telling him, sir, for recording a foreign currency transaction, the rules are different, which I'll tell you. For translating the foreign currency financial statement to a different currency is different. That is why it is important to identify the functional currency of your entity, which is RIL. And that is why it is important to identify the functional currency of this branch, which is in Singapore, or the subsidiary, which is into Malaysia. Now the CFO has understood. Now CFO is asked, Madam, how do you identify that? Namrata told, see, you have identified your functional currency, which is INR. Now you tell me the question of these four answers, whether the branch is independent or it is depending on you. CFO is saying, Madam, it is depending on us. So you can just assume that this branch is like just hamara hissa hai. It is just like our extension. We have formed that branch for expanding our business, right? Namrata said, okay. So what is the proportion of transaction with the parent? What is the proportion of this branch with you? So CFO is saying, Madam, we are supplying the entire material to the branch. The branch is only depending on us. The branch is not procuring material from anywhere, right? This branch is only our extension, and this branch is formed only for facilitating our sales. So Namrata says, oh, it is high. Third, Namrata asked, what is the financial independence compared with the parent? Whether the branch is managing its entire cash flow independently, or you are telling them you are managing their cash. So CFO told that we are giving 1 lakh rupees to the branch because there were some employees, rent will be there, right? So we are just giving them a budget of 1 lakh US dollar, right? 1 lakh rupee or 1 lakh Singapore dollar for managing the expenses, right? So Namrata is saying, oh, it means the branch is depending on you for managing their obligation, right? Fourth, Namrata is asked, so how much the cash flow of the foreign operation, cash flow of this branch is impacting you? CFO said, Madam, it is completely impacting us. If the branch will do high expenses, probably we will not allow them, or if the branch will not be able to recover cash, it is directly impacting our cash, right? Have you understood that? But if it would have a subsidiary which is independent, right? Doesn't matter whether they are able to collect or they are not able to collect, right? Have you understood this? understand with the help of an example as well. Foreign operation, as far as definition is concerned, it is an entity which is a subsidiary, associate, joint venture, or a branch. The activity of which are based or conducted in a country or currency other than those of the reporting entity. Right? Now let's discuss this case study to understand more about this foreign operation. Functional currency. Holding company H Limited has a business of supplying raw material to major steel makers abroad. Holding company is H Limited and they have a business of supplying raw material, raw iron ore to major steel makers abroad. So this holding company is supplying material and the steel maker, the finished goods manufacturer, are sitting in overseas country. For this purpose, it engages its subsidiary S Limited in Japan. Holding company H is in India. They have formed a subsidiary in Japan. S Limited, which takes order from Japanese customer and receive goods from the holding company. So what is the job of S Limited? S Limited is receiving the order from the customer, Japanese customer, and then then transfer it to the Indian company, which is holding company, and receive the goods from the holding company and supply to the Japanese customer. It also collect proceeds, which is always in Japanese yen, and remit it to the parent company. So S Limited collect the order, send the orders to the H Limited holding company. Holding company transfer the goods, S Limited receives it, and S Limited supply the goods to the customer, collect the money, and remit the money to the holding company. You can see this S Limited is only acting as an intermediary, as an agent, right? The whole of the funding of subsidiary is being managed by the parent company. And the entire funding, if the S Limited has to take some fixed assets, if S Limited has to pay the rent, staff salary, the entire funding is managed by the parent H Limited, including administration and other expenses. There is no other role being played by S Limited. So S Limited is completely formed for taking the orders, supplying the orders, collecting the money, remitting the money. That's all. Only from H Limited, no one else. Determine whether the functional currency of H Limited, which is parent, which is INR, can be considered that of subsidiary S Limited, or S Limited will have a different functional currency. In this case, you can see that the operation of S Limited is simply an extension of the operation of H Limited. S Limited does not have significant degree of autonomy. Hence, currency Japanese yen cannot be considered as functional currency of S Limited. You cannot say that. See, for Indian company it is okay, but you cannot say that, sir, S Limited is into Japan. They are supplying into, so they are getting money into Japanese yen, right? They're expensing, they're spending cash in Japanese yen. So Japanese yen will be the functional currency of this entity. Answer is no. This entity is acting as an agent, as an extension of the holding company. So in this case, the foreign operation functional currency will be same as of the parent entity functional currency, right? Why? Because it is meeting those conditions. For this purpose, the currency of the parent company INR will be considered as functional currency of the subsidiary also. Sir, the S Limited is formed in Japan, and you are saying they will have a functional currency of INR, but S Limited is a separate legal entity. I'm not saying legal means not illegal. Legal entity means it has its own obligations. Sir, S Limited is formed in Japan and it is a separate legal entity. They have to file the financial statement into Japan. They have to file the income tax return in Japan. So friends, in this case, Japanese yen will be the presentation currency of S Limited. Functional currency will still remain as a INR for this Japanese entity. Have you understood or you haven't understood? Have you understood or you haven't understood, guys? Yeah. Let's summarize this again. Additional indicator in case of foreign operations. First indicator, whether foreign operation is considered as an extension of the reporting entity. Answer is yes. In this case, the functional currency of of reporting entity, the functional currency of foreign operation will be same as of reporting entity. The functional currency of foreign operation will be same as of reporting entity, right? The proportion of transaction with the reporting entity, is it high or low? It is high. Again, the functional currency of foreign operation will be same as of reporting entity. Whether the cash flow of the foreign operation impacting the cash flow of the reporting entity? Answer is yes. The functional currency of foreign operation will be the same as of. Whether foreign operation is dependent on the reporting entity for managing its obligation? Answer is yes. So the functional currency of foreign operation will be the same as of the reporting entity. I have given you this summary in this Excel file as well, which I am going to upload with the presentation as well, right? Another one case study. Let's discuss this case study quickly. Then we will have a foreign currency transaction. Okay. Measurement and recognition. A small India Private Limited, a subsidiary of Big INC, takes order from Indian customer for Big INC merchandise and then bills and collect for the sale of the merchandise in rupees. A small also has a local warehouse in India, right, to facilitate timely delivery and ensure that it remit to its parent all cash flows that it generate as the operation of small are primarily financed by Big. Big is based out of US and his functional currency of US dollar. What is small's functional currency? Again, same example. So the example which I have given as a case study 4, this is the same example. Big INC is a US based company and they have formed a company, Small India Private Limited in India, and this company takes order in India. So they when they take order, they got the material from Big USA and then they collect the money and remit it to the USA, and the operations are primarily financed by the Big USA, right? So in this case, although the company is in India, but the functional currency will be same as of US entity, right? Is that clear? Last case study number 6 is an Oman based company having a foreign operations B in India. The foreign operation was primarily set up to execute a construction project in India. So A is a Oman based company. A is a foreign company and they are having a foreign operations B in India, right? And this foreign operation was primarily set up to execute a construction project in India. The functional currency of A is OMR. So who is the reporting entity? A is the reporting entity. What is the functional currency? OMR. Now, 78% of entity B's finances have been raised in US dollar by way of contribution from A. 78% of entity B, which is an Indian entity, have been raised in US dollar by way of contribution from A. So basically, A has raised the funds from US dollar and remit to the B for managing the finances. 78%. B's bank accounts are maintained in US dollar as well as in INR. So basically, if I talk about financing activity, so B finances has been raised in US dollar by way of contribution from A. Bank account of B is maintained in US dollar as well as INR. The cash flow generated by B are transferred to A on a monthly basis in US dollar in respect of repayment of finance, received from A. So whatever cash flow is generated by B are transferred to A on a monthly basis, right? In US dollar in respect of repayment of finance received from A. So basically, whatever cash flow B is generating, B is transferring to A. right? Why in US dollar? Because A has taken a loan in US dollar to remit the money to B, right? So B is repaying that and B is transferring that fund into US dollar so that A's loan has been repaid. The revenue of B are in US dollar, right? Its competitor are globally based. Tendering for the construction project happen in US dollar. B incurs 70% of the cost in INR and remaining 30% of the cost in US dollar. Since B is located in India, can presume its functional currency to be INR? Can it can presume its functional currency to be INR? Friends, this is a tricky illustration. And I want you to think about this illustration and give me the answer after 10 minutes. So let's have a 10 minutes break. It's 8:40 now. Let's have a 10 minutes break and we will start at 8:50. Okay. And just think about this question and then give me the answer. What should be the answer of this illustration number 3 from ICI study material, right? So let's have a 9 to 10 minutes break. We will start at 8:50. Okay. So Rohan has said that it should be US dollar. Rohan, why it should be US dollar? Surbhi has said that it should be OMR. Okay, guys, let's understand this again. See, this A is a company based in Oman. Oman is outside India, right? They have created a company B in India. First of all, why B has been created? So B has been created to execute a construction project in India, to execute a construction project, right? So it means the service has to be delivered in India. The site has to be constructed in India, and for which B, an entity has been created. 78% of entity B's finance have been raised in US dollar by way of contribution from A. So basically, this B has taken 78% of the money from A. 78% of the money from A. What does it mean? What does it mean? It means 22% is either, it means 22% has been collected from or managed from entity B's own sources, right? It means it is not 100%. It is not entirely depending on A, right? Second, B's bank account are maintained in US dollar as well as in INR. It means whatever money comes up, it is not transferring the entire money into entire money to the A, right? B is maintaining its bank account in US dollar as well as in INR. And whatever cash flow generated by B, so B is transferring to A on a monthly basis. Why? Because of repayment of finance. It is not like whatever money B has collected, it is directly remitting to A. It is not like that. So B is repaying the money taken from A, right? So revenues of B are in US dollar. B is earning in US dollars, and its competitor are globally based, right? And tendering of the construction project happened in US dollar. So revenue of B in US dollar, right? As well. And B incurs 70% of the cost in INR and 30% cost in US dollar. Since B is located in India, can it presume its functional currency to be INR? So functional currency cannot be presumed due to the location. First of all, it is clear. An Indian company may have a functional currency of US dollar. First of all, this is a wrong statement. Functional currency cannot be assumed just due to the location, right? We all are aware about that. Second, for identifying any functional currency, we need to look at primary indicator, secondary indicator, which we all are aware. Sales prices, cost, input prices, I mean to say direct cost, financing activity, and the cash of operating activities are maintained in which currency, right? If it is a foreign operation, we need to look at additional 4 factors. What are the additional 4 factors? What are the additional 4 factors? The additional 4 factors is, please tell me what are the additional 4 factors? Whether foreign operation is considered as an extension of the reporting entity, right? You need to consider that. So in this case, whether this foreign operation is considered as an extension to the reporting entity, yeah, it may be. It may be considered as an extension, okay? The proportion of transaction with the reporting entity. What is the proportion of transaction with the reporting entity? Is it high or low? It is low. So this parent is not transferring any material or anything which is not written in the, it is not given in the question, right? In the question it is written that 70% of the cost in INR. What does it mean? It means this B is managing the entire cost in INR, entire purchases in INR, right? It means A is not supplying anything. A is not supplying, right? This second condition, the proportion of transaction with reporting entity, it is not high, it is low. Third, whether the cash flow of the foreign operation impacting the cash flow of the reporting entity. whether the cash flow of the foreign operation impacting the cash flow of the reporting entity, it may impact. Okay. Fourth, whether foreign operation is dependent on the reporting entity for managing its obligation, answer is no. Why? Because they are managing 22% of the funds from their own sources. 78% they have taken as a loan from A Limited, which they are repaying also. They are maintaining their bank account in US dollar and INR, right? So first of all, for a foreign operation, whatever condition I have told you, 4 conditions, this entirely 4 conditions should be satisfied. If the 4 conditions are not satisfying, it means that foreign operation will be considered as a separate entity, and the functional currency of the foreign operation needs to be determined. Right? Is that clear? Is that clear or not clear? Janvi, Namrata, Sriram, is that clear? Rohan, is that clear? In this case, all the 4 conditions of foreign operations are not meeting. It means in this case, we have to identify the functional currency of foreign operations separately. Is that clear? Yeah? Not getting a response. I have only received a response from Rohan and Surbhi. Students, what about you guys? Sriram is saying clear, sir. Okay. So in this case, we need to identify what is the functional currency of B Limited. Why? Because all 4 conditions are not meeting. For identifying the functional currency of B Limited, again, we need to go to the primary indicators and secondary indicators, right? First, its significant revenues and competitive forces are in US dollar, right? It is written that revenue of B are in US dollar, right? So the first primary indicator, revenue, this is in US dollar. Okay. Second, the cost. Its significant portion of the cost is in INR. 70% cost in INR, 30% cost in US dollars. Please write down revenue. Please write down revenue. First of all, revenue. Revenue USD. Cost 70% INR, 30% USD. Right? So going by the primary indicator, the weightage is USD, right? 100% revenue, 30% cost. The weightage is more for USD. Then coming to the secondary indicators, 78% of the financing activity. 78% of the finance is in US dollar. Then cash flow. It is maintaining its cash flow from the operating activities. So maintaining its cash flow, operating activities. In which the currency? On a monthly basis, it is maintaining, these bank accounts are maintained in USD as well as INR. So USD as well as INR. You can see that going by the primary indicator and going by the secondary indicator, US dollar will be the functional currency. US dollar will be the functional currency. Is that clear? That clear? So with this example, probably are clear. Yes, Namrata, you need to fulfill all 4 conditions for taking the functional currency of foreign operations same as of the functional currency of the reporting entity. Right? Is that clear? In this case, A Limited functional currency is OMR, but B Limited functional currency will be US dollar. Right? And now we have reached one of the important part, which is accounting. So far we have understood the functional currency, foreign currency, local currency, how to identify a functional currency, how to identify a functional currency of a foreign operations, as well, right? Now we need to discuss about the accounting of foreign currency transactions. If you want to understand this standard in a beautiful manner, first of all, you have to be well versed with what is my functional currency, what is the functional currency of foreign operation, and how it has to be determined. I have already covered 6 to 7 examples to make you guys understand the meaning of functional currency, the analysis of functional currency, and the meaning and analysis of the functional currency of foreign operations. So I have covered the illustrations from ICI study material as well as illustrations from my own sources. Yeah, is that clear? So now we have reached to the accounting part, the first section of the accounting, that how to do the recognition and measurement of foreign currency transaction. For example, if Reliance has purchased a raw material today, which is 6 May 2023, today from a Chinese supplier, right? From a China. So that raw material has been purchased from China for 1 lakh US dollar, let's say. Let's say the Chinese entity is also raising the bill in US dollar, right? So for example, the rate of US dollar is 80 rupees. And this entity has purchased a raw material for 1 lakh US dollar. The invoice is 1 lakh US dollar, right? But we are Indian entity. We have to record this transaction in our books of accounts into INR, into the functional currency. So now, how to record, how to initially recognize this transaction and at what value, right? And at what value? So standard says that it has to be recognized at spot rate. Spot rate means spot rate on the date of transaction. Spot rate on the date of transaction, right? And what could be the spot rate on the date of the transaction? Spot rate could be, for example, today the spot rate is 80 rupees. Spot rate is 80 rupees, right? What is the value of the transaction? It is 1 lakh US dollar. It is 1 lakh US dollar. The value of the transaction is 1 lakh US dollar. So what accounting entry I need to pass? I need to pass purchases accounting debit or raw material account debit to foreign supplier account, to foreign creditor account, creditor, right? And the value will be 80 lakh rupees, 80 lakh debit, 80 lakh credit, right? Raw material account debit to foreign creditor account, 80 lakh rupees. Is that clear? So spot rate means rate on the date of transaction. Okay. So this is the initial recognition of the foreign currency transaction. So all the foreign currency transaction has to be measured in the foreign currency in accordance with the relevant standard. In accordance with the relevant standard. So first of all, relevant standard means inventory has to be recognized as per Ind AS 2. Your liability, financial liability has to be recognized as per the financial instrument. If it is a fixed asset, it has to be recognized or measured as per Ind AS 16 PP. So this standard does not talks about the recognition of asset and liability. This standard only talks about the recording of the foreign currency transaction, the translation of foreign currency into functional currency, the translation of foreign currency into the reporting currency, into the entity's reporting currency, right? So inventory account debit to trade payable. This entry is not given by Ind AS 21. Ind AS 21 has told that first of all you have to pass an entry. What entry you will pass as per the respective standard? Inventory account debit to foreign supplier account 1 lakh US dollar. But our books is in INR. So now we need to convert 1 lakh US dollar to INR. So when I'm converting US dollar into INR, so who will give me the answer of how to convert US dollar into INR? So Ind AS 21 will give the answer, and Ind AS 21 will say that you have to convert in spot rate. What is a spot rate? Spot rate, which is an exchange rate on the date of transaction. Is that clear? Yeah. Okay, sir. Sir, we understood that. But please tell me, for example, I am a company. Okay. This is a one transaction I have understood. Let's say I have a global operations. Okay. And every week or every thrice a day, every second day, every third day, I am getting a consignment. I am purchasing this raw material from my foreign suppliers, right? And I'm a big company. So I can say that in a month, I am purchasing this foreign currency raw material 10 times, right? Or let's say 50 times. India, so I am into India. So I'm purchasing the consignment from the USA, around 50 consignment in a month and 600 consignment in a year. Sir, for every day, for every consignment, do I need to check the spot rate on the date of transaction? So standard says that if you have a high frequency of transactions, if you have a high frequency of a transaction, for example, you are traveling on a regular basis, you are purchasing a raw material on a regular basis, you are paying to the consultants, you are getting a consulting services on a regular basis from the foreign suppliers, you are purchasing raw material on a regular basis from the foreign suppliers, you are selling to the foreign customers on a regular basis. Standard says that you can use the average rate as well. And I can tell you practically how these big companies are doing. These companies are having a treasury department, right? And what their treasury department is doing, their treasury department is issuing, for example, they have operations with 5 countries. Okay. They have transactions with 5 countries. So treasury department is giving them a monthly average rate for recording all the foreign currency transactions in that particular month. For example, May month is going on. So the treasury department has issued that for all the May month transaction, you can record the US dollar into INR, it's let's say 79 rupees, right? So standard says that if it is one of transaction, the concept is spot rate on the date of transaction. But if the transactions are on a frequent basis, then you may apply monthly average, quarterly average, weekly average, or yearly average, whatever suits you, provided there should not be the major volatility in the exchange rate. There should not be the major volatility in the exchange rate. Is that clear? Friend, all foreign currency transactions amount is measured in the foreign currency in accordance with the respective Ind AS. Then that foreign currency transaction is translated into the functional currency. Then you need to apply the spot rate between the functional currency and the foreign currency at the date of transaction. What is a spot rate? The exchange rate on the date of transaction, I would say. An average exchange rate for a specific period may be a suitable approximate rate for transaction during that period, particularly if exchange rate do not fluctuate significantly. For example, the company last year in the month of, let's say, February or March, the company was selling goods to Germany or let's say Europe. Okay. And what happened? The company has used an average rate. But let's say on 15th March, the war between Russia and Ukraine got started. The war. Due to this war, the exchange rate has been changed heavily, significantly. So in that case, the entity has to apply the spot rate on the date of those transactions or revisit those exchange rates, right? So guys, if it is one of transaction, you can apply the spot rate. If it is a series of transactions, frequent transactions like expenses, sales, purchases, you can apply a monthly average rate, weekly average rate, quarterly average rate, or yearly average rate, provided there should not be the major volatility between these average rate, right? Is that clear? Is that clear or not clear? Is that clear? Okay. So let me give an example here. Section number 1. Section 1. Translation. Let's say translation of foreign currency transactions. right? Translation of foreign currency transaction. A limited purchase raw material on 6th May 2023 for 1 lakh US dollars, right? On a credit basis. The spot rate between USD and INR is 80 INR per USD. Pass the necessary journal entry to record the transaction. The functional currency is INR, right? So what is my foreign currency transaction? It is purchase of raw material USD 1 lakh. Spot rate 80 INR per USD, right? Now what is the accounting? Raw material, let's say purchases account debit, purchases account debit, 1 lakh multiply by 80 to foreign supplier account, 80 lakh, right? So this is the accounting entry, and this is how this has to be measured at the time of initial recognition. This is known as initial recognition, right? Initial recognition. Now, assuming this amount remains outstanding till 31st March 2024, and the rate on that date is 85 rupees, 85 INR per USD. Now what will happen? For example, or let's say it is a listed company, and the amount remain outstanding as on 30th June 2023. 30th June 2023, right? 30th June 2023, right? So friends, I am talking about subsequent measurement, right? Standard says that initial recognition is very simple. It is on the basis of spot rate. If there are multiple transactions, you can apply average rate. But what should be the subsequent measurement? Standard says that for subsequent measurement, you need to look at, is it a monetary item or it is a non-monetary item? Is it a monetary item or is it a non-monetary item? Right? You need to look at whether it is a monetary item or it is a non-monetary item. If it is a non-monetary item, then nothing has to happen on the subsequent measurement. What does it mean? It means there will not be any change. There will not be any change in the restatement of foreign currency transaction. But if it is a monetary item, it is required to be restated on the reporting date. It is required to be restated on the reporting date. Sir, what is meant by monetary item and what is meant by non-monetary item? Non-monetary item is very simple. Non-monetary item are those items which is not a monetary item. Okay. Sir, then what is a monetary item? Monetary item are those items. Monetary item are those right to receive or obligation to pay monetary item, please write down. Monetary items are right to receive cash or obligation to pay cash. Right to receive cash or obligation to pay cash. Obligation to pay cash. Obligation to pay cash in a fixed unit. In a fixed unit, I mean to say in a fixed number. In a fixed number of currency. In a fixed number of currency. Right to receive cash or obligation to pay cash in a fixed number of unit of currency. I'll take an example. You are having an inventory. You are having an inventory in your premise, right? Do you have any right to receive cash? Do you have any right to receive cash till the time you will not sell the inventory? Till the time you will not sell the inventory, do you have any right to receive cash? Surbhi is saying no. Surbhi is saying no. Okay. Till the time you're not selling inventory, you don't have any right to receive cash. Whom? किससे लोगे पैसा? भाई आज की डेट में let's say I am a mobile seller and I have 10 units of mobile in my godown. So till the time it is remaining in godown, I don't have any right to receive cash. किससे लूंगा? किससे right to receive cash means मुझे किससे लेना है cash? But let's say I sold this mobile phone to Sriram or Viraj on a credit basis. On a credit basis. So I sold this mobile phone to Viraj and Sriram. Do I have a right to receive cash? Do I have a right to receive cash? Answer is yes. Why? Because I've sold the mobile phone. And whether this right to receive cash is in a fixed number of currency? Answer is yes. I can tell you that I have to receive 50,000 rupees from Viraj. I have to receive 40,000 rupees from Sriram. So when it was inventory, it was a non-monetary item. When it become a debtor, it become a monetary item. Are you getting me? Are you getting me? When it was an inventory, it was a non-monetary item. When it becomes a debtor, it becomes a monetary item. Why? Because when it is a debtor, when it is a trade receivable, you have a right to receive cash in a fixed number of unit of currency, or you have an obligation to pay cash in a fixed number of unit of currency. For example, you have purchased raw material. You have purchased raw material from the foreign supplier. So once you purchase raw material, you have recognized on the spot rate, initial recognition and measurement. Subsequently, on the reporting date, this raw material, this inventory is a non-monetary item. This foreign supplier is a monetary item. Why? Because there is an obligation to pay cash at the rate of 1 lakh US dollar. At the rate of 1 lakh US dollar. Are you getting me? Are you getting me? So 1 lakh US dollar, अपने को 1 lakh US dollar पे करना है ना, डॉलर का रेट जो भी हो, फिक्स्ड यूनिट कितनी पे करनी है? 1 lakh US dollar is the fixed unit which we are required to pay, right? So trade payable is my monetary item. Raw material per inventory is my non-monetary item. Is that clear? Guys, I have only received the response from the 6 students. Is that clear? Viraj, Sriram, Janvi, is it clear? Okay. So if it is a monetary item, it is required to be restated at the closing rate. If it is a non-monetary item, it is not required to be restated. Now you need to tell me what is monetary item and what is non-monetary item. Employee benefits to be paid in cash, salary to be paid in cash. Is it a monetary item or non-monetary item? Is it a monetary item or a non-monetary item? Salary to be paid in cash, outstanding salary. Obligation to pay cash, yes. Fixed amount, yes. Fixed number of unit of currency, we are aware. We have to pay salary at the rate of 50,000 rupees. Let's, yeah. Yes, it is a monetary item. Prepaid expenses, is it a monetary item or non-monetary item? You have paid an insurance premium for next 3 years. Do you have any right to receive cash, or you have a right to receive services? Of course, right to receive services. Yeah. Or you have, let's say, purchased an AMC, annual maintenance contract, for your computer, for your laptop, and you have paid for you have paid in upfront advance. So do you have right to receive cash, or you have a right to receive goods and services? You have a right to receive goods and services. So it is a non-monetary item. Provisions to be settled in cash. Provisions to be settled in cash. What is that? Monetary, non-monetary? Of course, monetary. Inventory. Monetary, non-monetary? Non-monetary. Intangible asset. You have the intangible asset. Using that in your business. Do you have any right to receive cash? Answer is no. Till the time you will not sell the intangible, you will not have any right to receive cash, right? So in that case, when you sell the intangible, this non-monetary, this intangible will be converted into receivable, and then this receivable will become the monetary item. Trade receivable. Trade receivable. Of course, whatever money you have to receive from the customer, that is your right to receive cash into a fixed number of units of currency. Long-term borrowing, your liability, your payment, you have to pay the loan. Yes, it is a monetary item. I believe monetary item is clear to all of you. Monetary item is trade payable, trade receivables, loan taken, loan paid, right? Payment of expenses, right? Payment of obligations. What is non-monetary item? Property, plant and equipment, intangible asset, investment property, biological asset, prepaid expenses, inventory. These are the non-monetary assets. Okay. Friends, now let's talk about the subsequent measurement. If it is a monetary item, it has to be translated at closing rate on the reporting date. And whatever changes is there in the exchange rate, it will be debited or credited to the profit and loss. So this is monetary item. Let's go to this example again. Assuming this amount remains outstanding till 30th June 2023, and the rate on this is 85 rupees per USD. Subsequent measurement. What is the accounting entry? Subsequent measurement. In this case, this has shifted from your closing rate. Closing rate has shifted from 80 to 85. Closing rate. ₹85 per US dollar. Right? In this case, what is the accounting entry? The accounting entry will be, now I have to pay $1 lakh to the supplier. Still, I have to pay $1 lakh. But now the value of this $1 lakh become 85 lakh rupees. I have to pay 5 lakh INR extra. Of course, I'll credit my foreign supplier account to foreign supplier because it is a monetary item and it has to be restated at the closing rate. Foreign supplier by how much? By how much? To foreign supplier by how much? 1 lakh multiply by 85 minus 8, because 80 rupees you have already recognized. I have to credit my foreign supplier by 5 lakh rupees, and this exchange loss will go to the P&L. P&L debit by 5 lakh rupees, right? Right. So this 5 lakh will debited in the P&L, and on the liability side, this foreign supplier will stood at 85 lakh rupees, right? This is the accounting entry and this is the accounting treatment of monetary item. Since this inventory is a non-monetary item, it is not going to be restated, right? It is not going to be restated. How this number will be reflected in the balance sheet? If I draw a balance sheet for this transaction only, a balance sheet for this transaction, probably here you have a liability, foreign supplier liability. Let's say on this side you have assets. So this liability will be foreign supplier by how much? 5 lakh plus 80 lakh, 85 lakh. You have inventory in your balance sheet, which is raw material, which is, let's say, 80 lakh rupees, which you have debited, right? And you have a retained earning. You have a retained earning because this is a loss. You have retained earning, negative retained earning of 5 lakh, right? So your balance sheet will tell it 80 lakh, 80 lakh, right? Inventory being a non-monetary item is not going to be restated, and this trade payable being a monetary item has to be restated. I hope this is clear to all of you. I hope it is clear to all of you guys. Yeah. Okay. Sir, now what about non-monetary item? I have told you, non-monetary item is measured at historical cost, means there is no restatement, nothing. It has to be measured at historical rate, no restatement. Translate using the exchange rate at the date of transaction, which is historical rate. So again, this inventory you have to again translate at the historical rate. तो 80 पे तो पहले ही कर रखा है, फिर 80 पे करेंगे तो डिफरेंस तो जीरो होगा, 80 minus 80 0. So of course there will not be any exchange gain or loss for non-monetary item. Okay sir, this is very easy. But what happens if you have applied a fair value model for your non-monetary item? For example, you have purchased a machinery or you have purchased a building, right? You have purchased a building in USA. You are an Indian company and you have purchased a building for your guest house in US. So building is a non-monetary item. It is PP, and whatever payable is there, it is a, let's say it is your monetary item, and you have paid the money as well. You have paid the money. Now the problem is you have opted for a revaluation model for this fixed assets. You have opted for revaluation model for fixed assets, right? You have opted for revaluation model for fixed assets. Now, what is that revaluation model? Means you are restating your fixed assets at fair value. Standard says that if a non-monetary item has to be measured at fair value, in that case, you have to translate that non-monetary item on the exchange rate at the date of fair value, right? So for monetary item, it was closing rate. For monetary item, it was closing rate, right? It was closing rate. Monetary item. But for non-monetary item, if it is at cost model, nothing is required. But if it is fair value model, so if non-monetary item is at cost model, means there is no fair value changes, then nothing is required. But if non-monetary item is measured at fair value model, like revaluation model, then you have to translate this non-monetary item at the rate, exchange rate on the date of fair value. Sir, why it is written that on the date of fair value? Why it is not written that on the date of closing, on the closing rate? Because the standard permits you, even you can do the revaluation or fair valuation even before the reporting date. For example, a company is revaluing all its building, right? So it can do the revaluation, it can start doing the revaluation from December and complete by March, right? For any building which they have revalued in December. So whatever rate in December was there, that building has to be restated with that particular rate. For January, January rate needs to be taken. For February, February rates needs to be taken. But for a monetary item, it is always the balance sheet date rate, right? But for non-monetary item, first you need to see, is there revaluation is done? Answer is yes. In that case, it will go to the, it will be restated on the date of fair valuation. Sir, but why we are restating non-monetary item on the date of fair valuation? Because जब आप उसको फेयर वैल्यू पे करते हो तो आप उसकी कॉस्ट को भी रिप्लेस कर देते हो, राइट? पहले अगर कॉस्ट मॉडल पे था और आपने उसको रिवैल्यूएशन किया तो उसकी कॉस्ट भी चेंज हो गई ना, उसकी नई कॉस्ट बन गई। तो जब नई कॉस्ट बन गई तो उस दिन जो मेरा रेट है मैं उस रेट पे उसको फेयर वैल्यू करूंगा, राइट? उस रेट पे उसको रीस्टेट करूंगा। नाउ सर, if we are doing the restatement translation on the basis of exchange rate on the date of fair value, of course there will be some difference, exchange difference. So where the exchange difference will go? Standard says that the exchange difference will go at the same place where the actual fair valuation change will go. For example, let's say for a property, plant and equipment, you have done the revaluation and there is a revaluation surplus. There is a revaluation surplus, right? So in this case, as per Ind AS 16, the revaluation surplus will go to other comprehensive income. So this exchange difference will also go to other comprehensive income. For example, the company has done the revaluation of fixed asset, and while doing the revaluation, there is a loss. There is a revaluation loss. The value has gone down. So there is an impairment. So standard says that, Ind AS 16 says that this impairment will go to P&L. So where the impact of exchange difference will go? The impact of exchange difference will also go to P&L. Yeah? Is that clear? Is that clear? Okay. So friends, let's understand this thing with the help of one example. So this we have discussed foreign currency transaction. Initial recognition will be at the spot rate. In subsequent measurement, monetary item at closing rate. Non-monetary item if there is no fair valuation. If the non-monetary item is continued at historical cost, like PP, intangible asset, investment property, inventory, then there is no translation. But if the non-monetary item is recognized at fair value, then subsequent measurement will be happen, right, on the exchange rate on the date of fair value. I hope it is clear to all of you. Now let's understand this with the help of this example. A limited functional currency is INR and year ending on 31st March, right? And year ending on 31st March. Yeah. So there is no concept of FCTR on foreign currency transaction. The concept of FCTR will come on the foreign currency translation of financial statement. In foreign currency transaction recording, there is no concept of FCTR. But in translation of financial statement of foreign currency into functional currency, there is a concept of FCTR. For translation of financial statement into a presentation currency, there will be concept of FCTR, right? But in this case, there is no concept of FCTR, right? If it is a monetary item, everything goes to P&L. If it is a non-monetary item taken at fair value, then the exchange impact has to go to the same place where the actual transaction impact of fair valuation has been recorded. Is that clear? Okay. A limited functional currency is INR and year ending on 31st March. On 1st April 2014, company buys a building for 1 lakh US dollar. The exchange rate is INR 54.48 is to 1 USD. On 31st March 16, the exchange rate is INR 55.54 for $1 and value of building is 1.1 lakh $, right? In this case, you need to, so advise the accounting treatment in case where the building is subsequently measured at cost model and revaluation as well as revaluation model, right? So in this case, first of all, on 1st April 2014, what we will do? We will do the initial recognition. Doesn't matter. Subsequently, it is cost or revaluation, but initial recognition will be happen at the spot rate. My transaction is for 1 lakh $, and my exchange rate is 54 rupees 48 paisa. Initial recognition, first of all, building is capitalized at the rate on the transaction date. So which is my 54.48 multiplied by 1 lakh, right? So this is 50 building account debit to bank account 54 lakh 48,000. Now let's come to the subsequent recognition. On 31st March 16, exchange rate become 55.54 paisa. It has increased by 1 rupee and 6 paisa, right? And the value of the building is also gone up by from 1 lakh $, to 1.1 lakh $, by 10,000 $. It has also gone up by 10,000 $. In this case, if it is subsequently recognized at cost model, right? If cost model adopted as accounting policy under Ind AS 16 for PP, then building is carried at historical cost and no adjustment needs to be made, right? Non-monetary item, remember, if non-monetary item is subsequently measured at historical cost, then nothing will happen. No restatement is required, right? But if revaluation model is adopted as accounting policy under Ind AS 16, then value of building needs to be adjusted for revised value, right? In this case, the spot rate was 54.48. The closing rate become 55.54, right? And the company has opted for revaluation model. And this revaluation has been shifted from 1 lakh to 1.1 lakh. Okay. So the company has done the revaluation 31st March 16. So in this case, what you are required to do? Let's say, if it was a Indian rupee, right? If this building was acquired in INR for rupees 1 lakh, and this INR become 1.1 lakh, right? So this 10,000 rupee has to be recorded in revaluation reserve, revaluation surplus. Accounting entry was building account debit to revaluation surplus 10,000, and this 10,000 should go to other comprehensive income as per Ind AS 16, right? But now it is a foreign currency transaction and there is a change of exchange rate as well. So if there is a change of exchange rate, in this case, this change of exchange rate will also go to the OCI, right? So there are two ways of recording this transaction. The first way, what you can do, simple, you can do this 1 lakh has become 1.1 lakh. So there is an increase of 10,000, right? There is an increase of 10,000. So what you can do, 10,000 multiplied by 55.54, right? This increase of 10,000 in the valuation of building has to be multiplied by the closing rate. I mean to say the rate on the date of fair valuation, plus on 1 lakh, you have to recognize the exchange difference between the spot rate at the time of initial recognition and the closing rate, the rate on the date of fair valuation. So this will come as 661,400, 6,61,400, right? So this building will be debited and entire 661,400 will go to other comprehensive income. But if the question will require that you have to split the revaluation number and you have to split the exchange difference number, in that case, how do you calculate that? In that case, you will calculate. Let me tell you. The impact of exchange difference and the impact of revaluation. Impact of revaluation, first of all. Impact of revaluation. What is the impact of revaluation? 1,10,000 minus 1 lakh. So what is the change in the fair valuation? 10,000 multiply by, if the rate would not change, right? If the rate would not change, then what is my impact of fair valuation? So 1,10,000 multiply by 1 lakh multiply by minus 1 lakh multiply by old rate, which is 54.48, right? So this comes out to how much? This comes out to 54.48 multiplied by 10,000. I believe it is coming out at 5,44,800, right? 5,44,800, right? So increase in fair valuation multiply by old rate. This will give you the impact of revaluation. Now, what is the impact of exchange difference? Impact of exchange difference. I think this is right now, 54.48 multiplied by 10,000. Is that right? So let me calculate on the Excel as well. 54.48 multiplied by 10,000. 5,44,800. This is my impact of, let's say, impact of revaluation. I hope my Excel file is visible. Impact of revaluation, right? I hope my Excel file is visible, guys. Impact of revaluation is 5,44,800. Now, impact of exchange difference. Impact of exchange difference. What is the impact of exchange difference in this case? This is, you have understood how this has come. 54.48 old rate multiply by 1,10,000 minus 1 lakh. Right? Second, what is the impact of exchange difference? 1 lakh, the old value multiply by new rate minus old rate. 48. Old value multiply by, मतलब मेरी old value में क्या change आया due to exchange difference? That is my impact of exchange difference. So this will go to OCI, right? This will go to OCI. Okay. 54.48 plus 6,50,800. So 55.54 minus 54.48, right? So this is coming out 650,800. 650,800, right? Impact of exchange difference will be 1,06,000. 1,06,000. 6,50,800, right? Is that clear? 10,000 minus multiply by 55.54. It is coming out at how much? 5,55,000. I think there is some error in this thing. So basically my impact of revaluation is 1,10,000 minus 1 lakh, and impact of exchange difference you have to basically you have to compute the impact of exchange difference not only on the old rate, you have to compute the exchange difference on this entire thing, right? On this entire thing of 1,10,000. Yes, basically the impact of exchange difference has to be calculated on this entire value. Okay, right? So it is coming out at 66100. Impact of revaluation you have to compute. Impact of revaluation you need to compute the change in value multiply by the old rate, right? This is how this will be there. 1,16,600. 1,16,600. 661,400. 1,16,600. 661,400. Is that clear? Is that clear or it is not clear? Is that clear? So friends, first of all, if non-monetary item has to be measured at fair value, you have to compute the value. You have to compute that non-monetary item on the basis of the exchange rate on the date of fair valuation, right? In this case, what we have did in this case, we have opted for a revaluation model where the building has been restated from 1 lakh to 1.1 lakh. So what we have did, so we have computed this 1.1 lakh on the new rate. So 1.1 lakh multiply by 55.54 minus 1 lakh multiply by 54.48. The difference will go to the revaluation reserve in OCI and the building will be debited. The simple thing, 1,10,000 मल्टीप्लाई करो क्लोजिंग रेट से जो आपकी फेयर वैल्यू वाले दिन का रेट है, माइनस करो 1 लाख मल्टीप्लाई बाय ओल्ड रेट जो आपने पुराना रिकॉग्नाइज किया हुआ है, राइट? तो इसमें क्या होगा, इसमें 55 लाख 54,000 माइनस करेंगे 54 लाख 48,000 से, तो 661,400 आपका डिफरेंस आएगा, राइट? अब इस डिफरेंस में मेरा एक्सचेंज कंपोनेंट कितना है और मेरा रीवैल्यूएशन कंपोनेंट कितना है. सो मेरा जो एक्सचेंज कंपोनेंट होगा और रीवैल्यूएशन कंपोनेंट होगा, मेरा एक्सचेंज रीवैल्यूएशन कंपोनेंट कितना होगा, 110 माइनस 1 लाख. 10,000 इज माई रीवैल्यूएशन कंपोनेंट, राइट? वो मेरा रीवैल्यूएशन कंपोनेंट होगा 10,000 का, राइट? और मेरा एक्सचेंज डिफरेंस कितना होगा, जितना मेरा टोटल 1,10,000 है, जितना मेरा बढ़ा उस पे मेरा कितना डिफरेंस आया, राइट? Yes. So, Sriram, that is what I'm telling you, Sriram. You can simply compute 110 multiply by 55.54 minus 1 lakh multiply by 54.48. You can compute. But if question will ask you that is split between revaluation and exchange difference, how will you do that? तो कैसे करेंगे? सबसे पहले मेरा revaluation का impact क्या है? What is the impact of revaluation? It goes up by 10,000, right? It goes up by 10,000. So considering the rate is same, there is no change in exchange rate. So 10,000 multiplied by 54.48, this will come as a revaluation amount. Now, what is the impact of exchange difference? So the impact of exchange difference should be on the entire universe, which is 1,10,000. So 1,10,000 multiplied by difference in the exchange rate, right? Is that clear? Tushar, is that clear? Is that clear or should I repeat again? The simplest calculation is closing value minus opening value. 110 multiplied by 55.54 minus 1 lakh multiplied by 54.48. The simplest calculation. The split, what is the change in revaluation? 10,000 at old rate. What is the change in exchange difference? Total value 110 multiplied by difference in rate. That's all. Is that clear? So let me clarify here also. Impact of revaluation will be computed for increase in revaluation amount multiply by old rate of exchange, old exchange rate. Impact exchange difference, the total revalued amount multiply by difference in exchange rate, right? In this case, 110 multiply by 55.454 minus 54.48, 1 lakh 10,000 minus 1 lakh multiply by 54.48, right? The second check, what is the impact? What is the total impact? Impact closing value minus opening value, the initial recognition, right? It is my 1 lakh 10,000 multiply by 55.54 minus, sorry, minus 1 lakh multiply by 54.48. 661,400, right? 661,400. Is that clear? Is that clear? Yeah. Namrita, is that clear? Yes or no? Okay, great. So this case study will help you in understanding the concept of how to translate the foreign currency transactions at the time of initial recognition, at the time of subsequent measurement, right? So you, at the time of subsequent measurement, you need to look at, is it a monetary item? Is it a non-monetary item? If it is a monetary item, life is very simple. You have to translate on the closing rate. If it is non-monetary item, the life becomes simplest if it is at historical cost. In 95% cases, it will be at historical cost. But if the non-monetary item has been measured at fair value, then you have to restate this non-monetary item on the rate at the date of fair valuation, right? Is that clear? Quickly, we'll discuss some questions. Presentation currency. Presentation currency is a currency in which financial statements are presented. So tell me, an entity can choose its presentation currency, right or wrong? Yes, it is right. Entity can choose its presentation currency. For example, HSBC Bank. It's a global bank listed in 5 stock exchanges. They have chosen US dollar as their presentation currency, right? Entity can choose its functional currency, right or wrong? Wrong. The functional currency cannot be chosen. The functional currency is depending on the facts and circumstances. It is depending on the primary and secondary indicator. For example, Tushar is a chartered accountant and he is signing a balance sheet of a company, right? And CFO is saying, Tushar, that, sir, I want to present my financial statement in US dollars, not for India or for outside India. Tushar is okay. Said, okay, you can do that. Just you need to uh, comply with the guidance given in Ind AS 21 for translation of financial statement into presentation currency. But CFO is saying that, no, I want to change my functional currency. Then Tushar will say that, no, you cannot change your functional currency because functional currency is not a choice. It comes from the way you behave. It comes from the way you operate, right? It is depending on your operations. Okay. If your operations will change, probably your functional currency will change. It is depending on the facts and circumstances, right? Same Reliance Industries, it can present in yen, it can present in US dollar, it can present in euro for different stakeholders, for different regulators, right? In entire world. Is that clear? This second part I will be covering in the next class. Let me know if there is any challenge in the first part. Let me know. The second part I will be covering in the next class. Okay. Is that clear, guys? Namrata, is that clear? Yeah. Janvi is saying no doubt. Okay. Since morning, what we have read this morning? This morning we have covered why this standard. I've told you that we will discuss into three parts. One, we will discuss the foreign currency transaction, translation of foreign currency transaction, which we have covered. Then I've told you we'll discuss the translation of foreign operation financial statement, the translation of financial statement into presentation currency. These two parts are similar. We'll covering in the next class, right? Then we have discussed the objective scope. We have discussed some important definitions. We have discussed the meaning of functional currency, primary indicator, secondary indicator. Then we did a lot of case studies, right? Then we have discussed the additional factors for the foreign operations, right? Where we have discussed we need to look at the whether this foreign operation is independent or considered as an extension of the reporting entity. Then we need to look at the proportion of the transaction with the foreign proportion of the transaction of foreign operation with the reporting entity. Then whether the cash flow of foreign operation is impacting the cash flow of the reporting entity, whether the foreign cash flow, whether the foreign operation is financially independent or it is financially not independent. Means for financial it is depending on the reporting entity, right? Then we have discussed foreign currency transaction, and we discussed that foreign currency transaction has to be initially recognized at the spot rate, which is the rate on the date of transaction. If there are a high frequency of transactions, you can use the average rate as well, right? Then we discussed for subsequent measurement, you need to look at whether it is a monetary item or a non-monetary item. If it is a monetary item, it has to be subsequently restated at closing rate. The difference has to go to the P&L. But if it is a non-monetary item, then you need to look at is it historical cost or fair value. If it is historical cost, so nothing is required, no translation, no restatement, nothing. But if it is a non-monetary item at fair value, then you have to restate this non-monetary item on the basis of exchange rate on the date of fair valuation. The exchange impact will go at the same place where the fair value impact will go for that item, right? This is what we have discussed in the form of this particular case study, right? So thank you, friends. Thank you so much. And in the next class, we will be discussing these two concepts. Bye bye. Take care.